Okay, if you're wading through real estate finance terms and it feels like trying to drink from a fire hose, you're definitely in the right spot. Our mission right now is simple, it's essential. We are going to zero in and help you crush the loan vocabulary section of your real estate licensing exam. And we're not just, reading definitions off a page here. We want to give you the context, the connections, the real application of these terms. So you walk into that test really understanding how lenders manage their risk and how borrowers, how you might interact with that capital later.
Absolutely. Understanding the structure is key. It's not just memorizing. You need to see these financial instruments as basically the lender's toolbox. If you get how something like amortization works or, why ARMs have caps, you're not just learning a word, you're grasping a principle. And that's what helps you pass the exam and honestly what helps in your future practice too.
Exactly. Couldn't have said it better. So let's get right into it. Welcome to the Real Estate Exam Deep Dive by Exam Scholar Real Estate Edition. Today, it's all about loan vocabulary. Let's start unpacking this with maybe the most fundamental concept in paying back debt, the real core mechanics. Let's talk amortization. This is the bedrock, really, for most home loans. It's that gradual paying down of debt through regular payments, right? Principal and interest. And it's specifically set up to completely wipe out that debt by a fixed end date. It's like a scheduled path straight to a zero balance.
And that's such a critical concept because it immediately sets up contrasts. Like when a loan is fully amortized, perfect. It hits zero, like you said. But then you hear balloon loan, and that term itself tells you something important.
Right. It signals it's only partially amortized.
Exactly. The regular payments weren't enough to cover the whole principal, so at the end of the term, you're hit with this one often massive final payment, the balloon payment.
Yeah, that sounds like it could be stressful if you're not ready for it.
It can be. And then there's an even more, let's say, specialized structure, the straight note. Now, what's really interesting here is the borrower pays only interest for the entire loan term. That's it, just interest.
So the principal balance, it just sits there.
It sits there untouched, which means the entire original loan amount has to be paid back in one single lump sum right at the end.
Wow. So it's like an interest-only loan followed by a balloon payment that's 100% of what you borrowed.
Precisely. Definitely higher risk unless there's a very clear plan for that final payoff.
Okay, that makes sense. Let's shift slightly to the actual cost of borrowing. Interest. Simple concept, right? It's just the rent you pay for using someone else's money, usually shown as an annual percentage.
Correct. And for most home loans, we're dealing with simple interest. Key point. It's calculated only on the outstanding principal balance, not compounded in the ways some other debts might be.
Just on what you still owe. Got it.
But what happens if that interest rate gets pushed way too high?
That's where we get into trouble, right? That's usury.
Exactly. Usury is illegal. It's charging an excessively high interest rate, basically, loan sharking in a more formal context. And the limits, the absolute maximum rates allowed, those are set by state law. It varies state by state, and sometimes by loan type, too.
Okay, so those are the foundational structures and costs.
Yeah.
Now let's move from that fixed rate world into something more flexible, but also potentially riskier. I'm talking about the adjustable rate mortgage, or ARM.
Nappy around.
The defining thing here is the interest rate isn't locked in, right? It changes over the life of the loan.
That's right. It moves up or down based on the movement of some underlying financial index, like, say, the rate on U.S. Treasury bills.
So the rate follows this external index.
Well, partially, the actual rate you pay is the index plus the lender's margin.
Okay, the margin, what's that?
The margin is basically the lender's profit margin and covers their cost of doing business. And here's the crucial part for the exam. Unlike the index, which fluctuates, the margin is fixed. It stays the same for the entire loan term.
So the index moves, the margin stays put. That's how they calculate the new rate at each adjustment.
Correct. Index plus margin equals your rate. Now, because ARMs have that variable rate risk, they usually come with some protections for the borrower. Caps.
Right, the caps. There's a rate cap.
Yes, a rate cap limits how much the interest rate can increase in total over the whole life of the loan. It's like a ceiling on how high your rate can ever go.
Okay, lifetime protection. And there's another one, a payment cap.
Right. A payment cap limits how much your actual monthly payment can increase at any single adjustment period. This helps prevent sudden, huge jumps in what you owe each month.
So rate cap is long-term total protection. Payment cap smooths out the short-term bumps. Got it.
Exactly.
Now, what if you want a lower rate, especially at the beginning, but maybe you don't want the risk of an ARM?
Ah, that brings us to a strategy called the buy down.
A buy down. So you're buying a lower rate.
In essence, yes. The borrower pays extra points up front, directly to the lender. Points are basically prepaid interest. In exchange for those extra points, the lender gives you a lower interest rate. This could be for the entire loan term or sometimes just for the first few years.
Why would someone do that, besides just saving on interest?
Well, saving interest is definitely a reason, but often it's about qualification. Think about it. If a borrower is right on the edge, maybe their debt-to-income ratio is a little high.
Ah, the lower payment from the buy down makes it easier to qualify for the loan in the first place.
Exactly. It can be the move that gets the deal done. It lowers that initial hurdle.
Smart. Okay, so we've talked about loan structures, costs, managing rate risk. What about leveraging the value you already have at a property? Let's talk equity.
Equity, a fundamental concept.
It's basically the difference between your home's current market value and the total amount you still owe on any loans against it, right?
Perfect definition. If your home is worth $300,000 and you owe $200,000 on the mortgage,
You've got $100,000 in equity. It's like your ownership stake, the value that's truly yours.
exactly. It's the money left over if you sold the place and paid off the bet. Your cookie money, as some say.
Ah, right. And you can tap into that equity without selling, can't you? Like with a HELOC.
Yes, the home equity line of credit, or HELOC. You negotiate a line of credit based on your available equity. It works kind of like a credit card or a checkbook secured by your house. You can draw funds as needed up to your limit.
And how are the payments usually structured?
Typically, during the draw period, you might only have to pay the interest on the amount you've borrowed. But then later, the principal becomes due, often as a balloon payment, or it converts to an amortizing loan. Depends on the specific HELOC terms.
Okay. Now, shifting gears slightly, what about loans that involve more collaboration or maybe sharing the risk or reward? I know the term participation loan comes up.
It does, and it can be tricky because it has two common meanings on the exam. You need to know both.
Okay, lay them out for us.
All right, meaning number one. A loan where the lender gets not just the standard interest payments, but also a share of the profits from the property or project being financed, like a piece of the action.
Okay, interest plus profit sharing. What's
Yeah.
meaning number two?
Meaning number two refers to a large loan that's actually funded or owned by multiple lenders. They band together and they share the profits and, importantly, the potential losses, usually in proportion to how much each contributed.
Got it. So one lender sharing in project profits or multiple lenders sharing in the loan itself.
Correct. And related to that first meaning, sharing in the upside, is the shared appreciation mortgage, or SAM.
Sam, how does that work?
With a SAM, the lender agrees to give the loan at a lower than market interest rate. A really attractive rate sometimes, but there's a catch. In exchange for that low rate, the lender gets a guaranteed percentage of the property's appreciation, the increase in value when the property is eventually sold.
So the lender is trading lower interest income now for a potential bigger payoff later if the property value goes up.
Exactly. They're sharing in the appreciation.
Okay, one more in this collaborative vein. The purchase money mortgage. This sounds important, especially for sellers.
It is. It's often called a take-back mortgage, and it's the classic term for seller financing.
So the seller is acting like the bank?
Essentially, yes. The seller extends credit directly to...
Passing the real estate exam can be hard, like really hard. Statistically, only about 50% of people actually pass the real estate exam on their first try. Those people that pass, they go on to become real estate agents. And the people that didn't pass, yeah, they either give up completely or have to try again. Both of these options are painful, disappointing, and upsetting. Exam Scholar Real Estate Edition has been named as the best real estate exam prep by multiple publications for 7 years in a row. If you are about to take the real estate exam, Exam Scholar Real Estate Edition is a no-brainer choice. There is no other real estate exam preparation service out there that comes close. To enjoy the longest membership time, lowest cost, real estate videos, audios, articles, flashcards, vocabulary, exam tips and tricks, a 1-year no questions asked refund policy, and be one of the 35,000 people that it has helped pass the real estate exam, then sign up in less than 5 minutes at www.realestateexamscholar.com.
buyer to cover part or sometimes even all of the purchase price. Crucially, the title does transfer to the buyer at closing, but the seller takes back a mortgage note and a deed of trust or mortgage document as security for the loan they just gave the buyer.
Got it. The seller becomes the lender.
That's the core idea.
All right, let's move into some more specialized repayment schedules. Ways loans get paid back that aren't just the standard level payment for 30 years. There are two I want to contrast: the growing equity mortgage and the graduated payment mortgage. They both have increasing payments, but work very differently.
Yes, very different outcomes. Let's start with the growing equity mortgage, or GG, sometimes called a rapid payoff mortgage.
Okay, GEM. Payments go up over time.
They do. The payments increase on a set schedule. But here's the key. All of that increase goes directly towards paying down the principal balance. None of it goes to interest.
So even though the payment is rising, it's aggressively attacking the debt.
Precisely. It forces faster equity buildup and dramatically shortens the loan term. You pay it off much quicker than a standard mortgage.
Okay, builds equity fast. Now, contrast that with the graduated payment mortgage, the GPM, also called a flexible payment plan sometimes.
Right. With a GPM, the payments also start low, often really low, and then they gradually increase or graduate each year for a set period, maybe 5 or 10 years.
Yeah.
After that initial period of increases, the payment then levels off and stays constant for the rest of the loan term.
So low initial payments, good for someone maybe just starting their career whose income is expected to rise?
That's the target market, often younger professionals, but there's a significant risk hiding in that low initial payment.
This is where we get into that term, negative amortization.
Exactly. This is critical for the exam. If those initial GPM payments are set so low that they don't even cover the amount of interest that's actually due that month.
Wait, the payment doesn't even cover the interest?
Correct. So the shortfall, the unpaid interest, gets tacked onto the principal loan balance.
So
Yeah.
your loan balance actually grows even though you're making payments.
That's a negative amortization. Your debt increases month after month in those early years. It's digging the hole deeper initially.
Wow, that sounds dangerous. How is that even allowed? Isn't there regulation around that?
Yeah, it's allowed primarily through disclosure. The risk must be clearly explained to the borrower. And yes, there are regulations about how much negative amortization can occur. It serves a purpose for borrowers who have a very high degree of certainty that their income will rise substantially, allowing them to handle the higher leveled off payments later, but the borrower is explicitly accepting that risk up front.
Okay, a crucial distinction. Know the risk of GPMs. Now, speaking of unique loan types, one you absolutely have to know is the reverse mortgage.
Yes, the reverse mortgage. Very specific borrower profile.
It's only for homeowners age 62 or older, right?
Correct. And interestingly, there are generally no income or credit score requirements to qualify for the most common types. The qualification is based more on the home's value and the borrower's age.
And the really unique part is no monthly payments to the lender.
That's the defining feature. The borrower doesn't make payments. Instead, the loan balance, the principal borrowed, plus all the accrued interest grows over time. The loan typically only becomes due and payable when the borrower permanently moves out, sells the house, or passes away.
And how do they get the money?
They can usually choose a lump sum up front, regular monthly payments from the lender to them, a line of credit they can draw on as needed, or some combination.
Fascinating structure. Okay, excellent. Let's wrap this up by looking at loans designed for maybe unusual property situations or specific purposes. What if you need financing for more than just one piece of land, like a developer buying a whole subdivision?
That would typically involve a blanket mortgage. It covers more than one parcel or lot under a single loan document. Very common for developers.
And if they have a blanket mortgage and sell off one lot, they don't want to have to pay off the entire big loan, right?
Exactly. That's why a blanket mortgage almost always includes a release clause. This provision allows the borrower, the developer, usually to pay off a predetermined portion of the loan and get that specific lot released from the blanket mortgage lien so they can give clear title to the buyer of that lot.
Makes sense. Keeps the project moving.
That.
Now, what if the loan includes not just the house, but also, say, the furniture inside, like in a resort condo?
That's where a package mortgage comes into play. It bundles both real property, the land and building, and personal property like appliances, furniture, equipment under one single loan.
So condo and furniture all in one financing package.
Yep, that's a common example. Or sometimes in commercial deals where specialized equipment is key to the property's value.
Okay, how about temporary financing, especially for building?
That's usually a construction loan, also called short-term or interim financing. It funds the actual construction process. A key feature is that the money isn't given all at once. It's paid out in installments called draws or advances as different stages of construction are completed and verified.
Right. You get money as the work progresses, and it's short term. So what happens when the building is finished?
The construction loan needs to be paid off. Usually, the borrower has already arranged for permanent, long-term financing. That permanent loan used to pay off the construction loan is called the takeout loan.
Construction loan first, takeout loan second. Got it.
And that construction loan, where you can take multiple draws, it's actually a good example of another type, an open-end loan.
Open end. Like it's not closed off.
Sort of. Think of it like a pre-approved line of credit built into the mortgage. It allows the borrower to borrow additional funds after the initial loan closing, up to a certain limit, under the original loan documents without having to go through a whole new application process. HLOCs are another example.
Okay, convenient for accessing more funds later. And just quickly, what's an open mortgage? Sounds similar, but probably isn't.
Not quite the same. An open mortgage simply means a mortgage loan that allows the borrower to pay off the loan principal early, before the official end of term, without incurring a prepayment penalty.
Ah, freedom to pay off early. Okay, nearly there. Two last specific structures. First, the wraparound loan. Sounds complicated.
It can seem that way. A wraparound loan is a form of secondary financing. It's a new mortgage that includes the amount still owed on an existing first mortgage, plus additional funds the borrower needs. Here's the key. The new lender, who issues the wraparound, makes the payments on the underlying original first mortgage. The first mortgage isn't paid off or disturbed, it's just wrapped inside the new larger loan.
So the borrower makes one payment to the wraparound lender, and that lender pays the original lender.
That's generally how it works. It's complex and less common now due to due on sale clauses, but you still need to know the definition.
Okay, and finally, a strategic move.
Right.
The sale-leaseback.
The sale-leaseback. Very strategic, especially in commercial real estate. Here, a property owner sells the property to an investor,
Okay, standard sale.
but simultaneously leases it back from the new owner. So the original owner sells the building but stays put as a tenant, paying rent to the new owner.
Why would they do that?
Big advantages for the seller. They get a huge infusion of capital from the sale, freeing up money that was tied up in the real estate. Plus, their future rent payments are typically 100% tax deductible as a business expense. And the buyer. They get a property with a creditworthy tenant already in place from day one.
Win-win in the right situation. Okay, wow. We really covered a lot of ground there. We hit the accelerator on some absolutely essential finance vocabulary, from the basics like amortization and the risks of balloon loans to ARMs, buy-downs, equity, HELOCs, participation loans, and those specialized structures like GPMs with negative amortization risk, reverse mortgages, blanket, package, wraparounds.
That's a lot of terms.
It is. But understanding these, really understanding them, is non-negotiable for passing your real estate licensing exam.
It really is. That deep understanding is what separates just knowing the word from knowing how it applies. It's crucial. And listen, to keep building that understanding and get access to practice questions, full exams, all that good stuff, definitely check out our exam prep course. It's at www.realestateexamscholar.com.
Absolutely worth it for focused prep. Okay, so as you're reviewing all these different loan types we discussed, here's something to really think about to synthesize. We talked about the growing equity mortgage, the GM, how it forces that rapid principal paydown. And we contrasted that with the graduated payment mortgage, the GPM, and its potential dangerous slide into negative amortization. So thinking purely about long-term financial strategy and wealth building, which of those two structures, the GM or the GPM, do you think ultimately encourages building wealth more effectively and safely? And why does that specific structure lead to a faster, more secure path towards full equity?
That's a great question to ponder. Really connects the definitions to strategy.
Definitely something to mull over as you study.
We really hope this deep dive helps solidify these concepts for you. Best of luck with your exam preparation.
Yeah, absolutely. Nail that vocabulary section. We'll catch you on the next deep dive.